Ever since the banks were created, they've been touted as the institution where responsible adults should keep the majority of their money. Fast forward to 2023, and you essentially can't do anything without passing money through a bank first, not even pay your bills. From your mortgage payment, your apartment payment, or even your car, every last one of these bills requires a bank involved to pass money through to get those paid. So today, I'm going to show you why you should never have anything more than your bills sitting in your bank account, and I'm going to give you 5 reasons why the bank is the worst place to ever house any excess money. Now, the first reason you don't want to keep any money in the bank is inflation. And if you don't know what inflation is, simply put, it's how much it's costing you to live from year to year. So bills such as the rent for your apartment, the food in your refrigerator, even the electricity that powers your house, all of those things begin to increase in time due to inflation. What you paid last year is not what you're going to pay this year for those same exact items. Now, this next part is extremely important, so I need you to catch this. Now, this information comes directly from the Federal Reserve website. So even though the feds have never come out and said they have a specific number for inflation on a year-to-year basis, our policymakers, so guys, the people we elect as officials, generally accept that 2% inflation or slightly below is an acceptable level of inflation. Simply put, they're saying that if an item cost you $10,000 last year, it's okay if it costs you $10,200 this year. That's an acceptable normal rate of inflation. Now check this out. This is a chart showing the last 10 years of inflation in the US. As you can see, from 2013 all the way to 2020, it's about a normal inflation rate at that 2% or below. But in 2021, we spike at almost 3.5 times the normal rate of inflation. We've continued that trend into 2022 and 2023, even though you can start to see it's finally on a decline. Now, you may be asking yourself, well, why did we spike so dramatically in 2021? Well, the truth of the matter is it's basic economics. It's supply and demand. COVID hit us in 2020, and the US government printed $5.2 trillion to give some relief to families as a result of COVID and all the shutdowns. So, all that free money that everybody was getting during the pandemic from the government, I'm talking about the unemployment checks, the housing assistance checks, the fake PPP scam loan checks. Yeah, all of that money contributed to that spike in inflation. Because when the government prints money, your dollar becomes less valuable because it's more of it, it's easier to get. So when the government printed that much money and just gave it away, they made your dollar less valuable. So companies like Walmart, Target, or your local gas station require more money from you for the same services because number one, they're not going to take any less profits just for your benefit. And number two, your money just isn't carrying the same weight, hence inflation. Now you might be saying that's all well and good, but what does this have to do with me keeping cash in the bank? Well, check it out. Now, as an example, I'm here on Chase's website and I absolutely love Chase, guys. This is my personal bank, but I'm going to look at both a checking account and a savings account since that's what most people have when they're housing their money. And I'm looking to see what are the benefits for opening up a checking account with Chase. And as I'm looking at these features, I don't see anything telling me that they're going to pay me any interest on the money that I deposit into this checking account. So now I'm here over on the savings account side since the checking account paid nothing. And it looks like right out the gate, they address that they do pay interest rates if you open up a savings account. Now let me take a look and see what kind of percentage I'm getting. Guys, I'm going to get a 0.01% annual rate of return on any money I deposit with the Chase savings account. So that's the second reason why you should never keep any extra money in the bank, because they're not paying any interest. So the whole time that your cash is just sitting in that account, it's not earning any additional money. And as a matter of fact, if you consider the inflation data that we pointed out in part 1, you are actually losing money by letting your money sit in a bank account. Now I'm going to show you exactly how those numbers play out. So now I'm coming over here on calculator.net and we're just going to scroll down here and we're going to hit the inflation calculator. Once we get over to this calculator, we're going to plug in, let's say you had $10,000 in an account that's just been sitting there. Now we get to select what date that we're going to start from for an inflation. So I'm going to choose January of 2020 and we're going to end in April of 2023. And we're going to see how much money we have lost if that $10,000 had just been sitting in that bank account. And here are the results. Guys, this is showing us that it would take $11,760 today to equal that $10,000 that you had in the bank account 3 years ago. Meaning you've essentially lost $1,760 by letting that money just sit in a bank, not earning any interest and not making your money make money. So I'll do you guys one better. This is a true story. One of my close personal friends who I speak with on a daily basis about business, stocks, investments, has a coworker who's had $250,000 in cash sitting in a bank account since 2020. And despite my friend's best efforts to get this person to invest their money, they just refuse to do so. All logic and rationale have escaped this situation. And because of that decision, this person has lost $44,000 in value on their $250,000 over the last 3.5 years. The reality is this: in order for your money to maintain its value throughout the years, it needs to, at least at the bare minimum, increase with the rate of inflation. So if inflation is going up at 1.5% or 2% or 3%, your money needs to be making at least that 2 to 3%. If not, you're bleeding out. A lot of you guys might be asking at this point, well, if my money's not sitting in a bank account, where am I supposed to put it to make sure it beats that inflation rate? Well, I got one better for you, and that leads me to my third reason why I don't leave money in the bank. Because why put money in the bank if you can buy the bank? Now, this is Chase Bank stock profile. So this is how you own a piece, guys. If you come to the stock market because they're a publicly traded company and buy some shares, you're now considered a shareholder, so you own a piece of Chase Bank. Now, at the time of this recording, to buy one share of Chase would cost you $138. Now, if we scroll down below, the first thing I want you guys to notice is the dividend yield, which is currently sitting at 2.87%. Now, a dividend, guys, is literally a paycheck that a company will give its shareholders just for simply owning the company. Now, if you remember earlier in the video, Chase wasn't willing to pay you anything for keeping any money in the bank account, but they're paying their shareholders 2.87% just because they own a part of the company. And I know 2.8% may not sound like a lot, but at least it's outpacing the 2% expected inflation rate every year, which means not only is your account not losing value, it's on a constant incline year after year. But the biggest takeaway I want you to notice is that if you would have bought during COVID, you could have got Chase Bank for under $100 a share. And even if you waited until the bear market, you would have been able to buy the stock for just slightly above $100 a share. Now, the next thing I want you guys to pay attention to right here is the chart. Now, right now I have it on a 3-year chart, but I'm going to switch it to a 20-year so you guys can see exactly what I'm talking about. Now, here's the 20-year chart for JP Morgan Chase. This big dip right here, well, that's COVID, guys, when the whole market collapsed. And then this second dip right here, well, that's the bear market that we've been going through for the last 1.5 years. And despite both of those huge moments in the market, what do you notice? Chase is still on a continuous uptrend. So now, going back to the example where we had $10,000 sitting in the bank account, if you would have just bought Chase Bank at $100 a share 3 years ago, those shares would now be worth $13,800. And no, that does not include the dividend of 2.87% that you would have also been collecting, which happens to add up to an additional $885. So now, instead of losing $1,760 due to inflation by just letting it sit in the bank, you've now gained $4,685 due to investments. That's a swing of $6,445. And that's only on $10,000, guys. And I do want to revisit our friend who's got $250,000 sitting in the bank. He would have earned over $22,000 in just his dividend payments. And if we take his $250,000 and multiply this by 38%, since JP Morgan went from $100 to $138, he would have earned an additional $95,000 just from the shares increasing in value. So our friend missed out on bringing $117,000 in value to himself, and instead he lost $44,000 due to inflation. That's a swing of $161,000. Ouch. Now, I know some of you guys may be a bit leery about investing in banks, given the current circumstances that so many regional banks just failed nationwide. But number one, I didn't say invest in regional banks. Notice I chose Chase. How about Morgan Stanley, Goldman Sachs? But if you absolutely refuse to invest in a bank, I have a different option for you. You can just buy a portfolio of stocks like SPY or VOO, which both represent the S&P 500, which is the top 500 companies on the market. And right here, you'll notice over the last 30 years, SPY has given an annual rate of return of 9.72%. And to top it all off, it's going to throw in an additional 1.54% in a dividend check every single year. The fourth reason why you should never keep any money in the bank is something we call fractional lending. Now understand this, guys. Fractional lending is the very foundation of what our current banking system is built on. In a nutshell, what that means is that every time somebody makes a deposit into their bank account, the bank only has to keep 10% of the cash on hand in reserves. The other 90% of it, they're able to lend out in loans to make money. So what does this look like in real time? Well, check this out. Josh deposits $1,000 into his bank account. The bank's like, cool, let me throw $100 to the side for reserves. Now I've got $900 to lend out to somebody who needs it. Sally then walks in the bank and says, hey, Mr. Bank, I need a personal loan to fix up my house. I need $900. The bank's like, cool, Sally, I got $900 I just got from Josh. Here you go, but you need to pay back this $900 with 5% interest. Sally says, thank you, Mr. Bank. I can take that deal. Sally then takes her $900 from the bank and deposits into her bank account. Happens to be the same bank. The bank then says, cool, let me take $90 of that $900, put it to the side for reserves. I've now got $810 to loan out to somebody else. John then walks in the bank and says, hey, Mr. Bank, I need a loan too. The bank says, okay, I got this $810 I just got from Sally. You want this, John? I can charge you 7% interest rate on it. John says, I'll take that. I need it real bad. I got some things I need to handle at the house. So as you notice, this process just goes on and on and on. But remember, Josh is the person that deposited the initial $1,000 to get the whole thing started. But he's not earning any additional money with all the new loans created. Why? Because Josh's checking account pays 0% interest. So Mr. Bank, you telling me you just created about 10 new loans with the money I deposited and I'm not going to share in any of the profits? Well, yeah, you cool with that? And so the story goes. That's fractional lending. Now, the last reason you shouldn't keep your money in the bank is because you'll have limited access to your funds. Now, this is a direct result of what we just discussed with the fractional lending, because the bank is not required to have all your money available to you at your beckoning call. And depending on how much cash you're asking for, the bank may even need to get additional authorization just to give you your own cash back that you deposited into their account. Some banks go as far as even saying that they have daily limits on how much money you can withdraw on your account. I'm forgetting, is it their money or yours? Either way, these are all reasons why if there's ever a run on the bank where everybody's trying to get their cash out at once, like what happened during the Great Depression, you're screwed because they don't have it. The bottom line is this: your money needs to be invested into assets, stocks, bonds, real estate, anything that can avoid all the pitfalls that I just outlined in this video. Now, I provided you guys with a couple of options on where you can put your money, so I do hope you learn something and start to take action immediately. Now, before you get out of here, make sure you hit that like, subscribe, and notification bell for me, and share this with your friends. If you have any questions or comments, feel free to leave those down below and I'll be sure to respond. I thank you for tuning in today, and I'll see you guys next time.